Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Madison Mills alongside Julie Hyman. Let's get you the three things you need to know today.
First up, U.S. stock futures extending declines this morning after the stock market wiped out more than $3 trillion in value on Thursday. That was after President Trump rolled out the highest tariffs in over a century. The sell-off was the S&P 500's worst drop since 2020. It fell 4.5%. The NASDAQ dropped 5%, and it wiped out $1 trillion from tech stocks. Meanwhile, the bid into safe havens is accelerating as China retaliates against Trump's tariffs, pushing 10-year yields below 3.9%, the lowest since before Election Day. Two-year yields dropping to their lowest since September 2022. Money markets are now fully pricing in 4 rate cuts from the Federal Reserve, up from just 3 cuts before the tariffs were announced.
Investors also digesting the latest jobs report, which showed 228,000 jobs added last month, well above the expectation for just 140,000. The report offering some reassurance that the labor market is still intact, but the unemployment rate did tick up just a bit to 4.2%. Meantime, investors will watch for comments from Federal Reserve Chair Jerome Powell later this morning as he sits down for a Q&A, which is likely to focus on how tariffs will impact inflation, the labor market, and more.
Plus, on the tariff front, China announced retaliatory tariffs of 34% on all goods from America. Prior to China's announcement, Trump said he is open to negotiations, contradicting White House aides who insist the sweeping tariffs are not a bargaining tactic. The president said he was open to reducing his tariffs if other nations were able to offer something phenomenal, in his words. Trump defended the levies, saying the economic turbulence would settle.
March data this morning signaling a still strong labor market, but Wall Street's attention remaining fairly fixed on President Trump's latest round of tariffs. Stock futures this morning extending Thursday's $3 trillion sell-off here. Economists can't seem to agree on what these tariffs mean for the Federal Reserve. Morgan Stanley seeing 0 cuts in 2025. Meantime, UBS predicting as many as 4. Joining us to discuss, Gus Fauché, PNC Financial Services Group's Chief Economist, also Brian Jacobson, Annex Wealth Management's Chief Economist and Strategist as well. Thank you both so much for being here. Brian, I want to start with you. I get the sense that you think that the market is overreacting to these tariffs. Why is that? What makes you confident that we're going to see compromise that leads to a bit of a rebound?
Yeah, thank you for having me. Yeah, when we were looking at the announcement from President Trump and even how he campaigned, we weren't really that surprised that he did launch these reciprocal tariffs. Obviously, the scope of them, that it was based upon a formula, and as far as the countries that were targeted, that was a little surprising. But we think that really this is a starting point for the negotiations. And we do need to wait to see, do these actually go into effect on April 9th? Right now, it's a rather intense period. We do have the certainty of the announcement, but now there's the uncertainty about how is this possibly resolved and at what level do the tariffs eventually settle at. So we think that it's actually understandable why the market would react in a negative way for it to the announcement, but we don't think it necessarily needs to, with the uncertainty, to resolve all that unfavorably as what the market is pricing in.
Gus, so not only are we seeing sort of some contradictions amongst White House staff as to whether these tariffs are open to negotiation, there's sort of contradiction from the president himself. He said last night, yes, these are up for negotiation. We're ready to start the negotiation now. Then he came out in a post this morning and said, my policies will never change. So if you're another country and you're trying to negotiate with him, how do you even do that? And how does the market interpret whether that's going to happen?
Well, I'm an economist and not a political scientist, so I can't tell you how other countries are going to respond. But what I can tell you is that this means that U.S. consumers and businesses are likely to remain on hold. We have these very large tariffs that are in place or are supposed to be put in place over the next week or two. But the president is talking about potentially rescinding at least part of them. How do you make a decision under those circumstances? You simply can't. And we need more clarity one way or the other so businesses feel comfortable making investment decisions. Consumers feel comfortable making decisions about a big purchase such as a car. And until we get some clarity, I think things are going to remain very complicated. I think we're going to see that uncertainty in and of itself is a drag on the economy until there's at least a clear picture of what these tariffs are going to look like over the longer run.
Well, Brian, going back to you, if you are potentially wrong and these tariffs are going to stick around for the longer run, where do investors need to potentially be hiding out while these tariffs take their effect?
Yeah, that's a great question. And that's one of the things that we really focused on when coming into this year is about what if we are wrong? Where do we want to be? And it's trying to really assess what's the distribution of possible outcomes. And so one of the things that we have been really focused on is focusing on profitable companies, those that are profitable even in the face of perhaps heightened tariffs on intermediate goods, final goods, and the such, that they have that margin of safety, not just from a valuation perspective, but even from the fundamentals perspective. And so I think that's what's really a little bit unique about the approach that we took coming into this year, which is why we've a lot of our portfolios have held up fairly well. I mean, it hasn't been completely unscathed, is that almost double focus on not just the valuation, but also on the fundamental side of things. And really right now, we're positioning more for, let's say, healthcare, financials, even some of the industrials that we think are going to be able to be relative beneficiaries. Maybe everybody loses in this game, but it's more a question of just kind of that story about if you're out hiking and you encounter a bear, you don't have to outrun the bear, you just have to outrun the person that you're with.
Speaking of fundamentals, Gus, let's linger for a moment on the thing that we would have been talking about today, more were it not for the tariffs. That's the jobs report, which did come in a little bit better than estimated. But do you just sort of discount this one or give it a lot less weight because we're waiting for the effects of both some of the government layoffs and the tariffs?
Yeah, I mean, certainly we do expect to see the government layoffs show up later in the data later this year. If you took a buyout from the federal government, you're still counted as employed. So many of those workers are not showing up in the job loss data yet. I expect that we'll see those hit in the second half of 2025. But that being said, the economic fundamentals are still good. We have a solid labor market. We have a low unemployment rate. Initial claims for unemployment insurance remain low. And I think that if this uncertainty is resolved, then we can return to solid economic growth that we've seen over the past few years with a solid labor market and slowing inflation. But I think the tariffs, the uncertainty surrounding the tariffs will be drags on the economy that are more likely to show up in the data later this year.
And Brian, going back to you on this, I wonder what you're telling clients right now amid this uncertainty, and more broadly, how they're thinking about whether or not a wrap up to that certain uncertainty could potentially lead to a lift in markets.
Yeah, so a lot of the clients, they're long-standing clients, so they have been with us for many years, and so it's a little bit easier in that situation because you can say, hey, let's take a step back, look at what's happened over the last 2 to 3 years. We do expect that in any given year, you could have a 10 to 15% decline, right? The last 75 years of market data suggests that the average drawdown in a given year is around 14%. So it's something that you expect. It's never pleasant when it happens, but if you take that step back and focus on where have I come and now where are we headed towards, viewing sometimes this volatility as an opportunity to upgrade the quality of the portfolio, to realign with that longer term financial plan. So really trying to just take that step back and take a breath to provide that perspective. But then also it's in terms of where's the opportunity in the moment to not panic, but to view it more as an opportunity.
Brian, what would make you panic? Or what would make you, you seem very even-keeled in the face of all of this. What would make you more concerned here?
Well, maybe that's just because, season of Lent, I gave up panicking for Lent, right? So we'll have to see what happens after Easter, after I can kind of go back to my normal skittish self. But in terms of what would make me panic would be if the Federal Reserve's messaging was a little bit more hawkish. What I heard from a number of officials yesterday, and we'll hear from Chair Powell, I'll be tuning in on Yahoo Finance later to listen to that, is if he's talking about, the inflation does have us more worried. But what I've heard so so far is that they are tilting more towards what's the growth slowdown effects. And so if the Fed was going to be more restrictive now that we have restrictive trade policy and arguably restrictive fiscal policy, I think that would really begin to make me think that we are going into a recession and that this correction becomes more of a bear market instead.
Well, we're going to hear from Jay Powell at 11:25 today, so we will be scanning that for any signs of an increase in that kind of sentiment. Gus, Brian, thank you so much.
Thank you.
Coming up on Morning Brief, we count you down to the opening bell on Wall Street with stocks set to open deeply in the red once again. Plus, we look at the biggest laggards in the tech space as Apple sees its biggest market cap wipeout ever. And later this hour, we'll have more on tariffs and the impact to the economy with Kevin O'Leary of O'Leary Ventures. That and much more on Morning Brief. No relief for big tech stocks today. They are plunging again after seeing their worst day since the pandemic yesterday, dragged down by President Trump's new tariff policies that sparked a widespread sell-off. Apple leading the declines among the Magnificent Seven stocks yesterday, seeing its biggest one-day drop since 2020. Joining us now in our studio, Dan Ives, Wedbush Securities Global Head of Technology Research. Dan, you tend to be a very positive guy on most of your coverage. And your notes in the past few days have been as pessimistic as I have ever seen them about what this is going to mean for technology companies. I mean, what kind of hit is this going to cause? And are you assuming that the tariffs are going to stay in place?
Yeah, and I'd say, look, in 25 years going through, when you think about dot-com bubble, burst, financial crisis, COVID lows. So, I've seen every type of crisis there is. I think it's the most absurd thing that I've seen in terms of those 25 years. And I think it's an economic Armageddon that's coming our way. And I think it could ultimately set U.S. tech back many years. And that's the thing that a lot of people don't understand. Talking to executives around the world the last 48, 72 hours is that I don't think a lot of tech companies are going to give guidance in terms of 1Q. And I think baked in here is already called 5, 10% cuts off the bat in terms of growth. If this stays, it ultimately, look, this becomes a black swan event. You're playing with third rail issue here.
Is that priced into these stocks if we see this kind of magnitude of decline hold today?
No, because obviously with China, they're not going to lay down. So
right, they've said this morning 34% tariffs right back on U.S.
Of course.
goods.
And then I think it also comes down to the tariff chart, which continues to be a sci-fi, sort of comedy show. Those are not the right tariffs. So it starts with what's the number you actually even start with in terms of negotiations? And the longer this stays on, you can't stop a snowball once it starts. So the point is do you burn the house down, but you still have a bagel in the toaster oven at the end of the day? And I think that's the frustrating thing right now for tech investors. Stocks are not Republican or Democrat. They speak volumes to what they're showing you, and I think that's the problem.
To the point of China retaliating with additional tariffs this morning, how does all of this play into the fact that the U.S. has been the dominant place for tech investors for so long? Does China start to outcompete the U.S. on tech?
It's a but just even go back to, for years, the reason China was such a bad market, you didn't know what the party was going to do over a weekend. So you couldn't invest in China.
Right.
To some extent, that's kind of what's happened here. So that's why I've seen so much global money going to Europe, going to China, going away, because you don't know what's going to happen. I think it just comes down to what's the reality? Is Back to the Future on TV? Is Hasselhoff on? We're not going back to 85 textiles in the U.S., despite whatever they say in the Beltway. The reality is that the U.S. tech infrastructure is built with supply chain in Asia. If you like $3,500 iPhones, we should build them in New Jersey. If you like $1,000 iPhones, you build them in China. And I think that fundamentally, and also it takes 4 to 5 years to build a factory.
And can we talk about that? Because I'm getting a lot of questions about your note on that. And people are interested in how you got to that $3,500. Mm-hmm. So for context, Dan had a note saying that the iPhone could be as expensive as $3,500 because of tariffs. Right now, it's around $1,000.
If they were built in the U.S.
Correct.
Now, off the bat, just on the tariffs, it's over $2,000. In terms of, you just look at the actual China tariff.
If I go to buy an iPhone after April 9th, How much is that? That iPhone's going to be $2,000. You think that Apple is going to raise prices immediately on iPhones?
I believe after Memorial Day, it's over 2,000. Because they can't, Julie, they can't absorb. We're not talking like 3 to 5% through the supply chain. They can't absorb a 50% hit, and then it depends on whatever. We gotta see what exemptions they get or whatever. That's why this is, look, it's a black swan event. Going back to 3,500, look, the reality is so many people that watch us from afar, they've never been to a fab in Taiwan, China. They don't understand. We don't even have you have labor where people, whether Starbucks, Chipotle, $22, $24 an hour. The reality is it would take them $20 to $30 billion in 3 years to move just 10% of the supply chain to the US. So you could talk in front of the microphones and the beltway and it could sound awesome. You could paint this fairy tale Pinocchio picture. Yeah. That's the reality, and that's what stocks don't lie, and they know it.
So when do you, because you're still overweight all of these names, when do you change your rating? Is it Memorial Day when you say the iPhone's going to be $2,000? What is it that causes that real fundamental hit?
Well, by then it's too late. Because I already think, like, just the fact that this happened, I'm already seeing the uncertainty across tech. You know, it's not just consumers, enterprises, hey, let's slow down CapEx. What does this mean? That's already factored in 5-10% cuts. If this actually goes into effect and lasts, let's say, a month, it's in my opinion, it's guaranteed recession. And you now start to be like, okay, now it's a game of chicken. Like, ultimately, when do the tariffs, do those get negotiated? What do they look like? But as it's happening, guess who gets hurt? It's the U.S. consumer. And that's why I just continue to stress is that all the companies and all the investors I talk to around the world, the reason I'm so negative is that this is a self-inflicted, worst policy decision in 100 years. And I don't even think it's a debate relative to everything I've seen.
So to Maddie's point, April 10th, do we see a wave of downgrades from Dan Ives if this is still in place?
Look, I think we got to evaluate what numbers look like. Because I can tell you right now, like NVIDIA, you're already baking in numbers come down 10, 15% at current price. So if you start to see some negotiations and you're able to basically be like, okay, toss out March quarter, okay? Because that's basically in the past, 2Q is going to be a disaster. Street will be able to look through 3Q, 4Q, okay, what's normalized 26. But to sit here and say, no, Tara, this is no big deal. I think they're not going to leave. You'd have to be from an alien nation to actually think that.
So for NVIDIA specifically, obviously the big deal, I mean, it's already sort of navigated around China to some extent. It's really the Taiwan tariffs, I would imagine, that are the biggest deal for the likes of NVIDIA. So what if the tariff stays in place on Taiwan? Like, what are we talking about?
And you guys see the semi piece in terms of like what they're actually, tariffed at. And
you mean if there's the sectoral
the sectoral tariffs? Right. And then the reality is that it's about growth. See, that is the biggest thing here. It's not even just the cost and the impact there. It's growth. It's company X being like, hey, I was going to spend on these projects. Let me slow down till we see what's happening in our business. And that's the problem, self-fulfilling prophecy as this comes out. And I just think it continues to be the most befuddling, absurd thing that I've seen, self-inflicted economic Armageddon. And I don't think there's a debate.
These tech CEOs who were proudly there on Inauguration Day, now the Mag 7 losing $1 trillion in one day. In your conversations with them, do you think that they regret that support?
Look, I think in Silicon Valley, they are dystopian. I mean, it was like they're waking up being like, it feels like an altered universe in terms of the way that Trump has navigated this handle. Reciprocal tariffs, you knew was on the table, 10, 15%, play games, poker, fine. But to actually try to build this chart from like the Goodwill Hunting chalkboard at MIT lab and say it's some fancy chart, it's basically, it's essentially a trade deficit converted into some weird tariff chart. It's not real tariffs. So that's part of the problem is that that's like me saying like I play in the NBA and my name's Jim. So how do you even know? Where do you even start with the conversation?
So as an investor right now, when you're looking at all of these large cap tech stocks that are falling, what are you telling people to do? Just do nothing? If you have them, just hold on to them and wait.
What we're doing is we're basically going through worst case scenarios. Where can NVIDIA earnings be worst case? What is Apple? Microsoft. So you have to do scenario analysis and then basically say, okay, based on this, is it base case, best case, worst case, do scenarios. And look, we're taking out the COVID 2020 playbook. So you're basically looking through, like, forget 2Q, probably forget 3Q. What do normalized earnings look like when you go out to 26, assuming that this normalizes? But then the problem is that you can't put the genie back in the bottle. Does it create something that's much more sinister in terms of a black swan? I think that's the worry.
Yeah.
And then also it just comes down to, like, the confidence in the Beltway. It's something that, unlike anything I've seen, I've navigated everything from .com bubble to today.
Right.
So that's why I don't just sit here. So many of those other moments were times that just you buy them, you don't work. This is one, you cannot say that given you don't know the rules of the game.
So really quickly here, how long for these stocks to recover, and how long until we start hearing about layoffs at these tech companies?
I think you don't have layoffs for another few months because until you have a good sense of what the actual policy is in negotiations. So I don't think any companies go down that route. But when it comes to, like, how low can they go, it comes down to, like, till you bake in a full-on deep recession into these numbers, then the stocks could continue to fall.
One more question, going back to the iPhone. If you're thinking you might want a new iPhone, but you've been going back and forth, you better go get it right now. I mean, are we going to see this sort of bump in Apple sales ahead of the tariff imposition?
Yeah, but that bump is it's meaningless relative to the dark storm that's coming. And then it comes down to, like, the average car is going to go up $5,000 to $10,000. So when the reality of that, UAW workers, they could be happy at that moment, but then all of a sudden when you have to lay off 15, 20%, your GM it's not such a happy day there. Yeah. So I think that's the reality, is that many are underestimating the unintended consequences of what's happening in the worst policy mistake in the last 100 years.
You know what you just reminded me of? How do we get through a conversation with you without talking about Tesla?
Yeah.
Is this, like, unprecedented?
Look, and the reality is when you look at Tesla, like Musk, I mean, it's moment of truth, because bottom line is the longer he stays in Doge, every day the brand crisis for Tesla expands and gets worse and worse. And that's why Tesla's become a political symbol, a debacle for Tesla shareholders with such great future. But it comes back to, like, this is a fork in the road for Musk when it comes to Tesla. He either leaves Doge, takes a huge step back, or this will be, I think, some pretty dark times.
Let that sink in, as he might say.
Yeah, exactly. Well, Dan, what a pleasure to have you in studio.
It's great to be here.
Thank you so much. Always appreciate your insights. I know the audience does too. We're going to bring you the opening bell on Wall Street in just a few minutes. Stick around.
That is the opening bell. Let's do a check of the markets on what looks to be another day of deep selling based on now what is the second day of overhang from President Trump's tariff announcement. And now the news this morning that China is imposing 34% tariffs on U.S. imports into that country. So expecting to see more selling today. The Dow off 960 points here out of the gate. We should mention, of course, we also got a jobs report this morning, which showed 225,000 jobs added to the U.S. economy. So we saw a better number than expected, but nonetheless, still seeing the Dow take a hit here because the emphasis does remain on the tariffs. The S&P 500 down 2.5%, the NASDAQ down 3%. And I want to take a quick look at some of the two-day numbers as well, just to show the depth of the selling that we have seen over 2 days. The NASDAQ down 8.7% over the past couple of days. The S&P 500 down 7% over the past few days. Jared Blickery watching the opening action, although I know, Jared, you're also going to be focusing closely on what happens at the end of the session as well.
Yes, exactly, Julie, because a lot of times after the payroll report, we get an initial move and then we kind of zigzag a bit with the end effect that we reverse into the close. Doesn't always happen, but it happens enough that we should be cognizant and maybe hope for that possibility. So I'll just you were leaving it off on the 2-day here. I'm going to mention stocks are in the midst of their worst 2-day slump since the pandemic, and many stock indices and sectors and individual stocks had their worst day since the pandemic yesterday. A few more stats. NASDAQ just had its first 1,000 point sell-off yesterday, and the Russell 2000, the small caps, I'll pull that up on the screen with the 2-day, that has fallen into a bear market as of yesterday. And also the Dow Transportation Index. So here are the Dow Transports down 11.5%, and they've been a leading indicator. I don't talk about them all the time, but they have been important to watch, and they have been leading down. Here's the VIX. I was tracking this earlier up to 37. Let me just check the high here. It was 45.56. That is pretty elevated. Not quite the highs that we saw in Yen-Mageddon last year in August, and that was kind of a one-off event. But my problem with the volatility readings is they just seem really comfortable hanging out at these elevated levels. Here's a 10-year T-note yield. That is down 15 basis points. Over the last 2 days, it is down 27 basis points. That is just a jaw-dropping amount. And we can see this is easily the lowest levels of the year. You'd have to go back to September, October of last year to find that comp. And let's skip over to see what's happening in sectors and everything in the red here. Energy leading to the downside, and utilities less bad off than the rest, and so is staples. Some of those defensives not as bad as the rest, but still getting sold off. I think it was staples that was in the green yesterday, and you can see over these last 2 days now, it's exactly flat. Energy is down 11.3%. I'm going to get to crude in a bit, but first I want to go to the NASDAQ 100 so we can see what the Mag 7 are up to. And there's a Roundtail Mag 7 ETF that is had its worst day ever yesterday. And you can see the carnage today. Let me just flip that over to a 2-day again so you can see some of the moves that we're talking about. Apple down 3% this morning, so is Nvidia, Meta, and Amazon down 5%. And the 2-day total is going to look worse if they punch up here. Looks like it doesn't want to cooperate, so I'm going to move on to China. China has been a bright spot, but unfortunately, and this is a 2-day, there is the NASDAQ 100 showing Apple down 12%. But here's China. This is showing a lot of red, and this is important because China has been a green spot. It has been a bright spot this year, and we're finally seeing some carnage this morning. Yesterday wasn't bad, looking a lot worse today. So maybe this is a global risk-off move that we are in right now. Got to go over to futures so we can check out the movements in crude oil. Crude oil is selling off the most since 2022. Another story of a big 2-day tumble. This is the overnight price action. I'll show you the year to date so you can see how it's just kind of fallen off a cliff here. There's your cliff line there. And if I put a 1-year chart, you can see, or maybe not, I'll try to get a longer one there. When's the last time we were at these levels? It's been quite a while. It hasn't been even 3 years. So 61.75, you're looking for lower gas prices. That's a good thing. But I don't think the Fed, Jay Powell over at the Fed, has any additional reason today looking at this report to say we got to cut. So that could be an issue for the markets. Sending it back to you.
Whew. Big breath there, Jared, after all of that. Thank you very much. It's time now for today's strategy session. China retaliating against U.S. tariffs today by imposing 34% tariffs on all imports of U.S. goods. What other areas could we see retaliation? We'll see. One question traders are debating is whether foreigners might scale back Treasury purchases. China and Japan will be particularly scrutinized. The two countries are the largest overseas owners of U.S. sovereign debt, with China already trimming its Treasury stockpile for 3 straight years based on the latest U.S. government data. Joining us now, Ed Al-Husseini, Columbia Threadneedle Global Rates Strategist. Ed, what a couple of days.
Good morning.
Here. It's pretty extraordinary to see nothing working, even gold, but people, when they're looking for safety, are looking to treasuries, seemingly. How does that strike you at a time when there is so much turmoil? Is that how things are supposed to be working in a way?
I think in many ways that's fantastic news for investors. There was always this question out there about whether treasuries had lost that hedging property against equities. 2022 was not a good year for a diversified strategy. And what we've done since is we've brought inflation down, and we're starting with relatively high yields. Again, this was last week. But we are starting with relatively high yields. And so for investors who have diversified their portfolios across risk and treasuries, they are in a really good place right now.
What, if anything, could break the bond market as a hedge for risk right now?
The biggest issue is unanticipated inflation. And so what's striking is even though tariffs are at the center of the story, they are going to generate some inflation in the short term. The bond market's taken the view that this inflation will be overwhelmed by the downside risks to the economy. If it turns out that this is not the case, that the Fed has to stay on hold, in the extreme that the Fed has to hike into this environment, that will be very damaging for portfolios and obviously very damaging for the real economy as well.
And yet there's still a lot of debate over whether the Fed can even cut in this environment, right, because of the tariffs. So how is that going to play out as the year goes on?
I think the Fed's calculus at the moment is roughly trying to weigh whether these tariffs are going to end up in inflation expectations versus the downside risk posed by financial conditions tightening very rapidly, lots of red on your screen at the moment. That's going to filter into the real economy in the coming quarters. And at the moment, I would say it's very likely that the Fed's going to look at financial conditions and say those things are going to dominate. That's a material risk to employment, and that's going to be our guide into the second half of the year.
So you think they focus more on the unemployment part of the dual mandate than inflation?
I think that's right, and that's roughly what the bond market is sniffing out at the moment.
What about the risk that we talked about in the intro? That is, you already have China imposing these 34% tariffs. They could, in theory, say, we're going to pull back on our Treasury purchases. What's the risk of that, and what does that do?
I think the good news for Treasury market investors is that the marginal buyer, really over the last decade or so, has been domestic here in the U.S. Foreign buyers have been stepping back from the Treasury market really for the better part of the last decade as well. There's still major holders. Japan and China really stand out as major holders of Treasuries. The odds that, as a matter of strategy, they're going to step back and sell Treasuries, I think, are very low, really for two reasons. One, they need those dollar assets in the event that there's a financial crisis at home. These are very important safe haven assets for that system. And two, if they sell Treasuries, they're going to incur those losses. So it doesn't make a lot of financial sense for them to do that, not at this stage.
Can we talk about the dollar as well, particularly as the global reserve currency? I guess first, can you just walk our audience through, it's a pretty good deal to be the world's reserve currency, right? So we don't necessarily want to lose that status. Can you explain why?
Yeah, absolutely. And it ties into the Treasury question.
Yeah.
The world is very willing to give us their excess savings, and we're very willing to take them and absorb them into our Treasury market and into our risk assets. And that allows us to live in an environment where we invest more than we save. That's not the case in China. It's not the case in Europe. They send their savings to us. And that's a very fortuitous environment for US taxpayers, because we're able to sustain relatively large fiscal deficits that are partially funded by these foreign investors that keep our rates relatively low.
Does the president's tariff strategy depend on a stronger dollar? And the dollar is not strengthening, it's weakening.
On paper, theory would tell you everything else held constant, if you impose tariffs, that will ultimately strengthen the dollar. You're importing less, you're exporting less. Ultimately, that's going to strengthen the dollar. Unfortunately, in today's environment, we've arrived at a point where markets are now looking at a higher probability of a recession, higher probability of Fed cuts, and that's ultimately weakening the dollar in this environment. So the dollar at the moment is actually exacerbating the impact of tax cuts into the year. You should never rely on the dollar to offset these policy risks.
So when you take a step back, there's a lot of investors who we speak with who say that they think that this is going to be okay because we're going to get negotiation, we're going to get tax cuts, we're going to get policy sweeteners. Where do you stand on that right now, Ed?
It's a little bit tough. In essence, we're raising taxes via tariffs. We're cutting taxes potentially later this year through the tax code legislation.
Or at least extending the existing cuts.
That's right. We're going to extend them. We might do a little bit more.
There might be more, right?
There might be a little bit more. And by the way, the more damage the tariffs do, the more likely it is that Congress is going to add those sweeteners in later this year. The problem is that the scale of the disruption, and it's unfolding in real time here, is really hard to control. And so odds are rising that the economy won't be able to handle the shock without significant fiscal support, without significant monetary support. And that's not really a good place for us to be.
Really well said. Ed, thank you so much for coming on and breaking all of that down for us. Really appreciate it. Coming up, we're going to have more markets action for you, so stick around and watch your morning brief. China hitting back at President Trump's latest tariff plan, with Beijing officials announcing it'll impose 34% levies on all U.S. imports, along with export controls on rare earths elements crucial for semiconductors and EVs. Our next guest says China's move marks the end of an era for global trade. Joining us, we got James Early, Tamarack Advisory's managing partner. James, always great to speak with you. I know you have significant experience in Asia. Talk to me about how much leverage the United States has in these negotiations, and did the U.S. just overplay its hand here?
Well, first of all, Madison, great to be here, but I feel like I'm living in a movie the past couple of days. It's just beyond reality, but it is reality. In terms of leverage, this is definitely a game of chicken, but the chickens are not equally sized. I mean, the U.S. exports roughly $140 billion of stuff to China every year, and China exports roughly $440 billion. So this trade war certainly hurts China more than it hurts the U.S., but at the same time, the Chinese populace and Chinese companies are more equipped to take that pain.
Well, and Trump sort of seemed to allude to this in his latest post on Truth Social this morning. He says China played it wrong. They panicked. The one thing they cannot afford to do. So then what's the next move? Or does he sort of sit back and, to your point, let them sort of incur the pain that you're talking about?
Well, I mean, the irony here is that this is an economic war, but it's really much more about domestic optics on both sides. In both cases, China and the U.S., the leadership wants to look tough to the people. Like, China basically had to react like this. So my answer, nobody knows, but it's going to come down to how the politics shake out. I would not be surprised to see this thing off just as quickly it was on in a couple of weeks, even a couple of days, or maybe it's a couple of months. Who knows, right? Maybe we get a deal for TikTok and Trump is appeased. It could be some little trigger just like that. But for now, it's not looking that way. For now, it's looking like China is opening the door to basically every other company affected by tariffs, which is basically every other country, affected by tariffs, which is basically every country, to retaliate in some shape, form, or fashion.
Yeah, what are the metrics for negotiation that we know of at this point, James? How can countries work with the U.S. to get a lower rate?
Trump said he's open to negotiation as long as the deal is, quote unquote, phenomenal. And defining phenomenal, unfortunately, Madison, is above my pay grade. I will say, Trump is certainly partial to things that favor causes that he likes. So certain deals, things that give him good political optics in the U.S., bringing jobs to the U.S., investing in the U.S. So things like making factories here. I don't think, to take the other side of that question, I don't think we're ever going to have a balanced trade relationship with every country, and we shouldn't. That would be irrational. That would grind the global economy to a halt. So just because we buy more than country A doesn't mean they should buy just the same amount. So that's not a realistic goal. There's just no way all these countries can afford what we export. I think we're going to see them making token efforts, or maybe more than token efforts, to establish some kind of presence in the U.S. that gives jobs, that gives Trump the optics that he wants, and hopefully it gives some kind of a balm to this trade war.
I think it feels like hope is about all we have at this point, James, that, in terms of what we know, because we don't know anything about what's going to happen. So investors are really having trouble pricing this in. You can see it in the action over the past couple of days. We have seen some buying in things like consumer staples. People are trying to figure out if there are safer places. At a time like this, are there safer places?
Well, I bought a little bit of VOO, the S&P 500 ETF, yesterday on the dip, and I'm already regretting it. If there are safer places, I'm not sure where they are. I mean, generally speaking, I like global companies. Generally speaking, I like high-quality companies now. I certainly don't like companies affected by the China-U.S. dynamic. And I think like banks and oil companies, the companies that are kind of like generally sensitive to recession risk in the global economy, those are probably not the place to be. I would be in high quality, relatively insulated companies, but my answer could change next week. This stuff is changing very quickly.
What would have been the ideal move, James? Would it have been to sell all of your equity holdings day after Trump was elected? Like, what would have been, in hindsight, the right move for investors to make?
Well, certainly the math would work out that way. We all wish we'd gotten out the day after Trump was elected. But if you look back, and if I may add a drop of optimism into all this stuff, that there have been so many panics, so many crises, and I've been investing for 26 years, and that's not a long time, but even I've lived through a lot of these ups and downs. I still wouldn't bet against the U.S. economy. I still wouldn't bet against the fact that all the best countries in the world still come to the U.S., even as flawed as we are. And even if someone's a Trump hater, terms only last 4 years. The U.S. still has a lot going for it. All the best brains come here. That may be changing somewhat. That may be diminishing somewhat. But I don't think the whole global economy is blown up. It's shaken, but not overly stirred.
Well, terms are supposed to last for 4 years, James, so we will hopefully keep that moving forward. I am curious. We were just talking about this with our last guest on set here. People have been telling us there's a recession coming for, ever, but also especially the last couple of years since that bear market back in 2022. Is this time significantly different, and why, if so?
Well, yeah, first, economists have predicted 15 out of the past 3 recessions. They've been calling for recession forever. This time certainly may be different simply because economics is a social science, and hiring decisions, capital allocation decisions are made by human beings. And when you give those human beings lots and lots of uncertainty, which is exactly what they've got now, they're going to pull back. All right, if I'm a CEO, should I invest billions of dollars to make a plant in the U.S. if I'm an overseas CEO on this tariff stuff? Well, maybe, but what if it changes in 2 weeks? I don't know. So I think people aren't necessarily running for the hills, but they're putting spending on pause, and that could be enough to start a recession.
James, thanks very much for your time. Appreciate it.
Sure thing.
We got much more markets action coming up. Stay tuned. You're watching Morning Brief. Let's get a check of the markets nearly a half hour into the trading session, and the selling continues here. All 3 major averages not really seeing any relief. The Nasdaq leading losses down 3.3%. Our Jared Blickery pointing out that the S&P 500 and the Russell 2000 are having their worst weeks since March of 2020. Looking at some specific movers, we talked about the China retaliation moves. One of the companies they named specifically was DuPont, saying that they are investigating the company's China unit for suspected antitrust violations. Those shares down 12%. Also, GE Healthcare caught my eye, the worst performer in the S&P 500 today. China not naming it specifically, but the company is investigating X-ray tube imports from the U.S.
All right, that's going to do it for the Morning Brief this morning. Join me in the next hour for more analysis on Catalyst and then Julie on Wealth. Stick around.